Welcome to the latest rendition of my series webinars at Epic Street. Thanks again to everyone at Epic Street for making this event possible. Thanks to each one of you for attending, and especially to those of you who participate. First, let me remind you the purpose of this event is education. I'm not going to provide specific trade alerts or recommendations. By the way, U.S. 10-year at 1.84%. But I will provide a look back, a review, if you will, of the trading day that is now behind us. The European trading day specifically that's now behind us, and we'll take a look ahead at what tomorrow might bring. Yeah, this was, this is one of those days where, unless there was a catalyst to spark a move, there was every reason to expect that volatility could be at a relative minimum for many currency pairs, even the euro, particularly the euro USD. And my reasons for saying that is really twofold. Number one, we're nearing the end of the year, unless there's any sort of unusual financial market turmoil, like we had in late 2008 after the Lehman Brothers bankruptcy. Unless there's something like that, an environment like that, we're looking at, year-end volatility gets at least a little lower. It's what we call thinner markets, just simply fewer buyers and sellers in the market, fewer traders. And, another way to look at it is, hedge funds have probably already, done what they're going to do with the currency market and, looking to wrap up trading for the year, close the books, and all that good stuff. Put a bow on 2011. So Monday, historically, Monday is known as the lower volatility trading day of the week, plus the end of the year. Plus, look at the factors that those seem to spark the most volatility in recent weeks. The events in Europe, for example, and we just got past some of the major market move events of the recent weeks, including the latest EU Leaders Summit on at the end of the first full week of this month, and we're past that now. So it's time for many reasons for arguably the market to take a breather. And even looking from a pure technical perspective, let's take a look at a euro chart here. I discussed in my New York session video review for last Friday, and get a euro chart going here first. Yeah, I'm looking at a daily chart here. Let me move some lines in this chart. And what I mentioned on that New York session video review for last Friday was a very common pattern of price action. You don't see my cursor here. Very common pattern of price action after relatively big moves is consolidation. Consolidation, generally defined by some sort of range-bound price action, smaller moves, limited price action within a sort of given trading range. That trading range could be a horizontal range. That trading range could be a ascending or descending channel, a slightly ascending channel, a slightly upper pointing channel. It's fairly common after a relatively big sell-off, which is what we've gotten really since that test of the major trend line that we got back in late October, after the short squeeze in response to the EU summit in late October. So the euro's been more down than up ever since. The euro has reached the 1.30 area, and again, we're near the end of the year, so I'm not surprised to see some. And as I said before, we have a relative lack of catalysts, new catalysts to spark new volatility. So it's, consolidation's been the name of the game ever since about the open of Wednesday's New York morning session. Let's go to a 4-hour chart here. Zoom in a bit. And I'm talking about, and I want to just roughly define it here. Here's the consolidation that we're talking about. Not the only way to define it, but one way to define it, that we're just sort of ping-ponging around in this in a fairly modest trading range compared to the kind of volatility we saw in days and weeks past. You might say sort of straddling the 1.30 level, sometimes above it, sometimes below it. Now, one of the clues besides besides lower volatility, besides defining a channel, a horizontal or ascending or descending channel, one of the clues to some sort of consolidation is you look at price action, specifically in the way it changes, or it can change from session to session. And one thing that we noticed late last week was that, and I mentioned this in Thursday's New York session video review, I think it was Wednesday's, one of the two, we talked about how it was like, up during London morning, down during the New York morning on the euro. Again, up during London morning, down during the New York morning was a pretty typical move on the euro. We saw that I believe last Thursday. We saw it last Friday, and for the most part, we saw it again today. So tough is kind of phase, if you will, to define a trend. You just kind of go with the flow, buy at support, sell at resistance, expecting anything you get is going to be fairly short-lived until we get some sort of a notable breakout move, or especially until we get some sort of catalyst to break the market out of its recent trading range. So again, the point I wanted to make was, for all the reasons I just mentioned here, it was reasonable to assume we would see, a sort of continuation of the consolidation type of price action we were seeing the second half of last week. So with that in mind, let me go back to the main set of charts here. Hey, Cintas, thanks for making it on time. Doing well, Cintas. Glad to see you here. Robbie asked about pound dollar. What can I say, Robbie? The same thing applies to pound dollar here. Obviously half of the pound dollar is the U.S. dollar. And, the dollar is doing its own form of consolidation. And Robbie, as I see it, and by the way, I notice, there's a lot of Forex traders that seem to focus almost exclusively on the British pound. I'm not assuming, Robbie, that you're one of them, but a lot of cable traders out there. And don't get me wrong, it's been a viable pair to trade. Even recently, I don't think quite as viable as the euro has been, but it's still it makes for some decent technical trading. But I also will add this though, from a news flow perspective, I just do not see, and I'm open to someone challenging me if they see it differently, if you see it differently, but I just do not see any pattern in recent weeks of news out of the UK affecting the British pound, the single currency, the British pound. I recall days like earlier this year, certainly last year and the year before that, when you'd have news, maybe like, for example, retail sales out of the UK released during London session, maybe be notably better than expected, and the British pound would be firm over the course of virtually the entire trading day. Or some other source of news, a different news report, being worse than expected, and the British pound being broadly weak throughout the day. I don't see any news out of the UK having any meaningful lasting effect on the British pound. And maybe a part of the reason, again, we know the focus has broadly been on the Eurozone, so that could be a factor. Well, another source of uncertainty which prompts volatility is central banking policy. In the case of the UK, we don't have any, as I see it, any really large questions left unanswered right now. The Bank of England was in their October Bank of England meeting. The Bank of England announced its latest quantitative easing program, and you can expect that just to run its course. So there's from that perspective, there's in the market's probably just not ready to ask any. To do any more speculation, ask any more questions about what's the Bank of England's next move, because they're still in the midst of the latest quantitative easing program. And again, like I said, the market's focus has been on Europe. So Robbie, I don't know if it's going to go below 1.53. I would say that depends largely on what pound dollar does. I'm sorry, what the euro does, specifically what the U.S. dollar does. Yeah, Tom says the pound dollar has a mind of its own. There's seems to be some truth to that. So Robbie, you may not like my answer, but I would say it largely depends on what the dollar does, and that's largely been dictated, as I see it, by what the euro has been doing. I will say this, and this is purely speculation on my part. Let me show you a chart for pound dollar. I'm sorry, a chart for euro pound, and I'll go back to. I'll focus more on the euro here and talk about the trades we discussed on the euro today. I'm going to show you a daily chart for the euro pound. Now, we know the euro has been increasingly weak over time, and that's part of the story here. But I'm guessing, especially when you look at gilt yields on government bonds in the UK, I'm wondering if part of the story here, the euro pound trend, and part of the story is the British pound as not certainly by no means a key rival safe haven currency to the dollar or the Japanese yen, but by its own right, the British pound may be catching a bit of even a touch of a safe haven bid, especially given the money flow back into gilts. Now, from my perspective, that makes trading the pound dollar could make trading the pound dollar a bit tricky, because we know that the U.S. dollar is a safe haven currency, and if the British pound is catch some safe haven type flow as well, then that could be for some tricky trading on the pound dollar. If you have two safe havens, it could become increasingly like trading dollar yen. Two known safe haven currencies there. Again, that's purely speculation on my part. I don't think demand for British for UK assets like gilts, for example, is anywhere near like it is right now for U.S. assets or for the U.S. dollar for that matter. But something to think about. Also, if you look at the commitment of Treasury report, if you look at the futures and options market, the market still, that is, non-commercial accounts, proxy hedge funds, still very net short the British pound. So if you have a bias for the British pound, it's definitely down. But I would guess if concerns still linger about Europe, you're not going to see quite as much downside for pound dollar as you will for the euro USD. Rafi, I don't spend a lot of time in these events talking about, I wouldn't call that a crazy exotic cross, but no, I can address individually the Canadian dollar, but pound CAD, yeah. I stick mostly to the majors here in this event, or refer to individual economies, and that's a pound CAD cross. I won't probably won't spend a lot of time on. All I can tell you about is this. If you look at look at the Canadian economy, its banking system is in pretty decent shape, but Canada's obviously very heavily tied to the U.S. economy, and if the U.S. economy struggles, so will to some extent Canada. And plus, it's Canada's known as a commodity-rich country, and commodity currencies certainly have been known to be under pressure when you have a risk-off mood in financial markets, and even given the prospect of like a slowing Asian economies, particularly China. I don't recall. Let me check it here. What I'm checking is the latest commitment of trader figures for the Canadian dollar. So in the background, I'm looking up I'm on the CFTC's website. And I'm going to pull up the latest commitment of traders report, which, by the way, I have a graphic to show everyone later. A graphic to show everyone regarding an update on the commitment of traders figures for the euro, the common currency. Canadian dollar. Yeah, it's there's markets net short the Canadian dollar, and probably in part for some of the reasons said earlier. You don't have as quite the Canadian central bank not quite as hawkish as what it used to be. Plus, if the U.S. economy slows, that's going to be if anything, it causes a slowdown for the Canadian economy. Plus commodity currencies under pressure if there's a concern about slowing growth amongst the emerging economies. So, here's a dilemma. Here's a dilemma on, so I just from a pure commitment of traders perspective, you look at a positioning in the for so-called non-commercial accounts, which I'll explain this later in reference to the euro, the common currency. But if you look at the commitment of traders report, you have in the futures and options market hedge funds short on the British pound, short on the Canadian dollar as well. So from that perspective alone, what do you do? I would say, if anything, maybe you conclude that the Canadian Central Bank is simply more hawkish than the Bank of England, and from that perspective, you bet down pound CAD. Yeah, we're all doomed. But yeah, one reason I took you with the euro pound chart, as I'm getting back to focus on the charts here, I'm looking at a weekly chart, and we're near the lowest point on euro pound since about February. And this euro pound is a pretty decent gauge for the British pound historically. I mean, there have been some times in recent weeks and months when the euro pound has seemingly been more guided by sentiment for or against the euro. But again, historically over time, this has been a pretty good gauge for the British pound. And if we break for those below those February lows, then that the day we do that, if we do that, then it could be a good day to long the British pound. And of course, the key on that day, if that happens, could be finding something along the British pound against. Is you like to find in that case a weak or even a neutral currency. Anyway, food for thought there on euro pound. So try and trade. I see try and traders comments about canceling it out. Yeah, that's kind of what I was getting at there. I'm not saying it isn't tradable. It's just that you'd like to have a better mismatch of strong versus weak, or strong versus neutral, or weak versus neutral when it comes to trading or assessing the potential for a move, medium and long term, on the currency pair. So again, I mentioned a theme earlier that's been prevalent over at least the past couple of trading days, like euro up during London morning, down during London afternoon, or put another way, up during London session, down during New York morning session. And you can already see that's essentially what we got. Let me show you I'm going to go to an hourly chart. We'll give you some perspective here. You should see a row of four arrows pointed down. They all highlight highs. Highs mostly achieved late last week. One high achieved earlier. I think it's earlier today. I want to make sure I got my date right there. Actually, this was just basically Friday's close. Friday's close and today's open around that same level. That level represented by the horizontal red line just above 1.3040. So you see the tops there, right? So I'm essentially ignoring that spike up, during Friday's New York morning session. If you ignore it, I mean, I'm not saying that it's meaningless. I'm saying, besides that 30-40 area has held. So that 30-40 area, its history of putting a lid on the euro is that was driving one of the keys behind a short, looking for a short around the 30-40 area today. Today's central pivot point on the euro, just below 30.40. I don't have it here, but I believe I have 30.37, 1.3037 for the daily central pivot point for this currency pair. And interestingly enough, we reached that combination of daily central pivot point and recent resistance in the 1.3040 area. We reached that at basically the open of the New York morning session. So again, going back to that theme we've seen in recent trading days, up during London, down during New York. I mean, what could be better for a euro bear at the open of the New York morning session than to see the euro at prospective resistance? So that was it. I mean, short, say, at or just maybe just below 1.3040. That was arguably the trade of the day right there. Yeah, there was other options. For example, we talked about this 1.3030 level. Let me zoom in a little bit on this chart. You can see look on the left-hand side of this chart. Let me make this horizontal blue line a little thicker. Not that it's terribly important, but just to draw attention to it so you can see what I'm talking about here. All right. So you can see on the left-hand side of this chart, London session high. London session highs around 1.3030. Moving to one of these arrows here. And then you can see a swing low established just below 1.3030 after the open of today's New York morning session. So the chance of short right in there. Hello, Arend. Right in here. And you can, I don't even have to draw the fib study to tell you that's, just by eye, that's roughly a 50% fib of the move down. Actually, no. I can add some labels here. Okay, so I got number 1 point. And there we go, number 2 point. So the 50% fib retracement level, roughly speaking, from the number one of the drop down from the number 1 point to the number 2 point, right there in the 30-30 zone, which again seemed to define today's London morning highs. So you could if you missed the short around 1.3040 around the open of the New York morning session, there was a second chance around 30-30. And we talked about this 1.3005 zone, believe it or not. Yes, I did talk about that specifically during my live coaching session today. If you zoom out, and I've got these lows highlighted by two upper pointing red arrows. The two lows you see here near the middle of the chart. So we talked about the 1.30 to 1.3005 zone as a target for one of those shorts, depending on your entry. Again, not many pips, but for all the reasons we described earlier, lower volatility on Monday, continued consolidation, that was a viable target. Now we were holding out hope. Well, Trident Trader says perfect short. I don't know if there's in my quant-driven mind, I don't know if there's such a thing as a perfect trade, but that was a very, very logical trade. I'll give you that. One thing we were talking about in terms of news flow, something that could have moved the market today. There was a testimony by ECB President Mario Draghi to European Parliament today, and what we discussed in my live coaching session was the possibility that Draghi could say something which the market could perceive as a hint or something, a comment that might just sort of open the door to more notable easing by the ECB and possibly even a full-blown quantitative easing. I see that's very doubtful. There's the ECB has not led on to any hints of doing such thing. But right or wrong, I thought the market might perceive from Draghi's comments to European Parliament today a hint that could be forthcoming. Well, Draghi didn't provide any such thing. In fact, speaking of Draghi, he was the ECB president was interviewed by the Financial Times, and excerpts from the interview were published in today's Financial Times. So you're reading through that, and there weren't even any hits in that either. That Draghi wasn't really showing his hand too much. I mean, he certainly didn't reveal anything new over and above what was discussed at the last ECB press conference a week ago, last Thursday. And really everything else in terms of trades on other pairs flowed from that. With the euro topping out around the 30-40 area, around the open of today's New York morning session, there's reason to assume the dollar could rally from there, and you can in turn, you could have looked along the dollar against another currency, your pick. And as we're nearing the bottom of the hour, I'm trying to think what else we discussed today in our live sessions at FX Bootcamp. I think that was pretty much it. While I'm on the topic of the euro, I meant to show you the commitment of trader, the latest figures from the commitment of traders report. The graphic I'm about to show you, I've shown this kind of graphic before, but this maybe is new to some of you at least. So in a moment, you should see a graphic over my MT4 charts. This graphic is comprised of some vertical blue bars, some point down, some point up. Also a maroon color line. Thank you, Census, for confirmation on seeing the graphic. The maroon color line, that connects the closing prices on Tuesdays. On Tuesdays of each week going back to the first week of 2009. Now, why do I pick Tuesdays? Well, the Commitment to Traders report published by the CFTC, the updates are published on Friday, but those Friday updates published by the CFTC, what they reveal is positioning in the futures and options market as of Tuesday of each week. So, for example, the latest Commitment to Traders report published last Friday shows positioning in the futures and options market for different currencies, including the euro here, as of last Tuesday. So what I've done is I've overlaid relative positioning in the futures and options market with the closing prices on that day that the positioning was measured, the closing prices for the euro USD. And you can roughly see it. I mean, it's a little rough, but maybe not as rough, maybe rougher to some than others, but roughly speaking, with the error. There's the Commitment to Traders, the relative positioning. Yeah, Robbie. If it's okay with Robbie, it's okay with me. Relative positioning has been a sort of guide, if you will, a sort of guide to what the euro will do. Yeah, I've ruined it, Gam. Now it's interesting. Hold on a minute. Yeah, I'm on the very last throes, if you will, of a cold, and I still have to. If I speak for lengthy periods of time, I'd have a cough to deal with. So got past that. Look at where we are now. Let me explain what this means. Actually, let me dig up the website. I'll show you where I've gotten the latest figures from. So you should see on the bottom right-hand corner of this graphic a blue bar, which is almost minus 120,000. Let me show you the origin of that figure, so you can play along at home or wherever your office is. Okay, let me post a link. And of course, if you look at this web page, it shows a number of different tables. I'm looking at the table that pertains to the euro, so Euro FX. And I'm not knocking doing that. What I'm saying is this: my analyses, my studies have concluded that. And listen, the non-commercial accounts. That's the difference here is that non-commercial accounts. Those are those, for example, hedge funds. These are the guys, these are the traders that are making speculative bets on whether the euro will gain strength or lose strength over time. Commercial accounts, these are the guys that are hedging, that are only taking long or short positions, long for the euro, short against the euro, from a pure hedging perspective. And you can make some arguments about focusing more on commercial accounts. I'm not going to deny that, but I have found that historically that correlation between the euro USD, for example, and positioning amongst the non-commercial accounts, it's pretty solid correlation. It's like I believe 0.85 is the correlation coefficient last time I checked it. It's very solid, a positive correlation between non-commercial positioning, net positioning, and the euro USD. So I focus on non-commercial. I know I'm not the only person who does so. So what do I mean by net positioning? Well, simply put, it's this. You see two columns here, long and short, right next to each other, long and short. So what I'm looking at right now, what I'm highlighting right now, as of last Tuesday, so-called non-commercial accounts were sitting on nearly 36,000 long contracts. And there was more than 151,000 short contracts shorting the euro. Yes, Gam, it could. Gam, again, I'm trying to keep things simple. But you make a relevant point. So back to this. So longs and shorts. Notice we have a lot more shorts than we have longs. A lot more. I guess a lot is relative because if you don't know what, historically how at times how many more shorts that have been in longs, you wouldn't know the history. But simply put, in this example, notice there are more shorts than longs. So when it comes to establish what I call net positioning, take the longs, subtract the shorts, you get net positioning. So if you take nearly 36,000 minus more than 151,000, you get a negative number. That tells you the market is net short the euro. Are there any questions about that? That's the simple analysis, simple answer, if you will, to how, for example, how hedge funds are positioned. Again, these so-called non-commercial accounts, a proxy for hedge fund positioning. Okay, no questions, good. So you can see that from that view alone, the market is net short the euro. So if you do the math there, 36,000 minus 151,000, take the difference. What is it? 115,000, roughly 115,000. So keep that number in mind, about 115,000. And that points us to this latest vertical blue bar. That figure is roughly about 115,000. And notice that it's lower. That net position is even lower, even more net negative on the euro than it was in the middle of last year. And also notice the difference in price on the euro. The euro is, as of last Tuesday was just north of 1.30. Of course, I don't have the euro USD scale on this chart, but you can look at your charts and where the euro closed last Thursday. It was 130-ish, the 130-ish area. By comparison, when the market was this negative on the euro last year, close to it, we were just plunging the depths of like 120. Yeah, again, Gam, I won't argue with you there. It's a reasonable assessment. I'm just trying to keep things simple here in the limited time that I have. And again, Gam, I'm actually and for those who are wondering, what I'm about to get to is for me anyway, the more the comment, the more valuable, at least for me, the more valuable way to use this tool. I find it most interesting to use the commitment of traders report to define or to assess when the market looks overly bullish or overly bearish. Here's my point right now at this point in time. This could dictate, or this could have some bearing on price action. If not in the next couple of weeks, and especially because there's no obvious maybe no logical catalyst to spark a big move, but in the coming weeks, here's a reasonable conclusion that the market is so bearish in the euro right now. There's so many different traders, so many different hedge funds, so many different traders short on the euro right now that the market is poised for a notable short squeeze. It's one way included that maybe the market's oversold on the euro. Now, having said that, this is only a warning sign, nothing more. You got to be careful with this, because you may notice that at least as of a couple weeks ago, the net euro shorts, the market was net short on the euro to a degree a week ago, seen in April, early May of 2010, and yet the euro dropped even more. So there's definitely potential for more downside on the euro. But having said that, what I'm saying is that if when we get a catalyst to spark short covering on that day or that week or that month or whatever, when that catalyst emerges and when that short covering begins, it could be one heck of a move. One heck of a move. But again, futures and options market is very, very, very net short on the euro. Yeah, try trading. That's another way to put it. The ratio there. And now I'm pondering what else I wanted to cover today. I'm usually I rarely run short of things to talk about, but what can I say? It's been that kind of day, and it's that time of year as well. It wasn't a whole lot of news flow today. I already mentioned Draghi didn't have much to say. Volatility was at a minimum. I mean, what can I say? I mean, the euro dropped, a little more than 40 pips from its high to low during the New York morning session. I mean, that's a pretty modest day. So since it's back to that commitment to traders report, what I'm saying is that this may sound strange, but I deem it to be true. I mean, the euro could go either way. I mean, this may not sound helpful, but the euro can go either way. There's a part of me that says, I mean, the euro could certainly tank in a big way to the downside given the right catalyst. But you could also conclude that given the right spark and some short covering, the euro could rally a lot too. In other words, it's an awkward spot where you hate to bet against the market. I mean, the market's clearly, look at price action alone. The euro is clearly down. Everything it's telling you with the euro is down, but it's just a warning sign. The commitment to traders report is, you might say, merely a warning sign that the market might be oversold on the euro. I'm going to show you some euro charts here. I'm going to go to the daily chart here. And the latest example that I can recall of a short squeeze on the euro right in there. You should see my cursor moving next to what's arguably the biggest green candle on this chart. That was a response. It was a Thursday. And early that day, in the early part of the Asian session that day, that was one of the recent EU leaders summits when it was announced during that day's Asian session that European leaders and representatives of Greek bondholders agreed to a voluntary 50% haircut. That sparked a rally on the euro during that day's Asian session. This was Wednesday evening my time, Wednesday evening New York time. And the euro spent the whole day rising. And again, that was arguably a short squeeze. That move was arguably triggered in large part by euro bears, at least some euro bears, getting out of their shorts, being knocked out of their shorts. But notice that's the last time we saw a notable sustained rally on the euro. It wasn't even a day later when the euro was dropping, and it's been dropping more than rising ever since. So since you got that short squeeze, it implies that bears are just getting out of shorts, just getting knocked out of their short positions. It's not driven primarily by a whole new set of bulls jumping in, although bulls jumping in can be part of the move. Going back to last year's move, I'm not going to spend a lot of time on this, but I suggest you look at some of the patterns of price action last year during last year's euro sell-off. I mean, we could see a repeat of that where, if and when if you suspect that the euro selling is over, just look at look at some of the patterns of price action from last year. I mean, you got to look at a number. I would argue you got to look at a lot of other things as well. Commitment to traders report, news flow. Is there something that would provide a catalyst for some short covering or short squeeze plus maybe some fresh new bulls jumping in? But I mean, what can I say on this view here alone? You're talking about just a lot more red than green, And maybe I'm trying to oversimplify, but that's one of the things I look for. When do you start seeing, in the case of a trend shift, when do you start seeing not only more green candles but bigger green candles? I mean, you can certainly say since the sell-off from late October, it's not only have there been more red candles than green candles, but the green candles have seemed to have paled in size comparison to the red candles. I mean, yeah, of course, you're like, duh, that's the definition of a downtrend, right? Well, it could be an interpretation of future price action could come down to basics just like that. For example, if you're looking for a recovery in the euro, I mean, start with things like a bullish engulfing candle or tweezers or the biggest green candle on daily chart that we've seen in maybe weeks. I mean, start with that. Start with that, and then until we get something like that, then you might conclude that, hey, you're looking primarily for chances to short the euro. Gam, I've got one. Gam, actually, you know what? When you say that, and the more and more traders who think that way, the more and more hedge funds who think that way, that what could possibly be good news for the euro, that in and of itself is a bit of a contrarian indicator. When, and this applies to multiple financial markets, when just no one wants the euro, when no one can imagine what could be positive for the euro and for the eurozone, that's a sign the market be oversold, and it's sign, and that's when I would be paying more attention to eurozone news, and it could be a situation where, boy, even the mildest of positive news could spark a rally. But in the grand scheme of things, looking maybe months ahead, maybe sooner than I think here, but I can tell you what could be one positive for the euro, and it may seem what's the term I'm looking for? Counterintuitive. It may seem counterintuitive. But if any of you ponder the possibility of, what if Greece were to leave the euro? Would that be could it be a short-term euro negative? Absolutely. But could it be perceived as a medium-term euro positive, maybe even a longer-term euro positive? I see that as very possible, folks. Very possible that as weaker eurozone countries leave, the remaining core that you have left would be seen as stronger. So what you'd have is a relatively stronger euro, and Greece's readopted currency, the drachma, would just tank. I've got a graphic that I could bring up tomorrow. I spotted it earlier today. A graphic showing different scenarios. Well, I've showed a similar graphic before, but this is a fairly new graphic that shows different scenarios for, I believe, multiple markets, even economic scenarios for individual countries. But I'll make a note here to discuss that tomorrow. Yeah, the core could just be Germany. Yeah, you have to wonder if that's what's going to be left. Yeah, there's and Gam, I don't know if this is what you're implying, but there's been a number of different scenarios bannered around. I've heard ideas of the weaker countries like Greece, who knows, maybe even like Ireland and such, leaving the euro. By the way, the U.S. 10-year down to 1.82%. It's been a steady drip down for the U.S. 10-year yield, which, if anything, suggests a risk-off mood. So yeah, weaker countries leaving the eurozone is a possibility. And it's all speculation at this point, but some have discussed the possibility of stronger core countries like Germany, like France, although their strength is somewhat in question right now. Who others? The Netherlands, Finland, maybe leaving to adopt like a second euro, just a separate euro-like currency. But you're talking about this is way down the road here, folks. So at least for us day traders, it's way down the road. On a quick look ahead, there is some news this week. I don't recall a whole lot on the calendar for tomorrow. A Eurozone statement expected shortly after ECOFIN meeting. Yeah, the European leaders were meeting today to discuss, I believe, funding for the IMF. So, folks, I don't know what else I can say here. I've run past my time. I don't want to. I've been running past my allotted time so often in recent weeks, and I don't want to do it again. And this is the week leading up to the Christmas holidays. So, unless there's a real game-changing event in Europe, which I kind of doubt, I think we're on a holding pattern right now, and this is the kind of period where either you don't trade at all. I mean, that's actually a reasonable strategy, not trade at all, given the prospect of lower volatility, or if you do get opportunities to trade. You know, you're probably going to wear a scalper's hat, take some very short-term trades, and maybe it's a good time to simply lower your lot size to reduce your risk, because as I find in times like this, thinner market at the end of the year, I mean the charts, especially the indicators, just don't tend to work quite as well as they usually do. And it may be like this, where you get some volatility, and it could be a mix of some days like today when there's hardly nothing happening, but, some modest moves, but nothing significant. And other days you get exaggerated moves, if in fact there is any news flow, which could spark some volatility. But on average, I expect some. Let's put it this way: I would not, unlike say U.S. retailers who make so much of their profit for the year and around the Christmas holidays, as a trader, I would not anticipate doing that. I would not look to make your year or make maybe your start of next year. Get off to a big start early next year after the turn of the year here. This is a time when you've done what you're going to do this year. Maybe it's you pick a few scalps here and there and grab a few pips along the way, but you don't bet the farm at a time like this. One thing, this is a good time for those of you who work on your trading game to work on certain strategies or to work on certain skills. Maybe your difficulties with entries, work on those. And maybe your challenge is holding trades. Now, holding trades could be a little bit tough in this environment unless you adjust your expectations. Maybe if your challenge is holding trades, maybe you're looking to hold a trade long enough to instead of scalping for 20 pips here and there, maybe you're scalping for more like 40. I don't know if that's a good example, but that's one I count right now. And as Michael implies, just study the markets. And what am I doing about this time of year? I'm looking for the next. Actually, there's some longer term reading I'm doing. There's some new books out on the financial markets that I'm reading through. But this is. And by the way, there's nothing wrong with taking a break during this time of year as well, because you can get too deep into this stuff and too busy and spend too much time staring at charts for hours and hours and hours every day. It can have its wear and tear. So do take some time off. And it's art to be given two choices, and I'll wrap up with this thought. Given two choices, you can either spend a lot of undue time trading what could be a very choppy market the next 2, 3, 4 weeks, or you can take some time off, sharpen your saw in other ways. Maybe just get away from charts, some rest, relax, do different activities. Maybe study some things like Michael's implied there. Study some, get away from the charts, but still study something related to foreign exchange, and come back with not only sharper, but with some kind of renewed enthusiasm for trading. Hopefully tempered enthusiasm. You don't want to approach trading with too much enthusiasm, because that can lead one to overtrade or take lower quality of setups, which is never good. Eating mince pies. Good for you, Gam. Nice. Well, folks, that does it for today. We'll do this again tomorrow. Starting in about 23 hours, we'll do another webinar here at FX Street. Thanks to everyone for joining me and us, and thanks especially to FX Street for making this event possible. Have a great day, morning, afternoon, or evening, depending on where you are, and we'll see you tomorrow. Cheers.